Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we're diving into Centerspace's latest proxy statement. And let me tell you, there might be some turbulence ahead. Will shareholders approve the new compensation plan? And what's this about changes on the board? Let's find out. This document is essentially Centerspace's invite to its shareholders for the annual meeting in May. They'll be voting on a few key things like who gets to be on the board of trustees, how the executives are paid, and a new incentive plan for employees. Plus, they will be voting on whether to keep their current auditing company. The board is recommending yes to all of these proposals, but let's see what's actually going on. First up, the election of trustees. Centerspace wants shareholders to vote for 7 nominees to serve on the board for 1-year terms. These are the people who oversee the company's direction and make big decisions. It looks like there's been a little bit of a shuffle here. One of the trustees, Jeffrey Kyra, is retiring and won't be standing for re-election. Because of that, the board is shrinking from 8 to 7 members. They appointed Jay Rosenberg as an independent trustee last year. He is independent for purposes of serving on the board under the rules. The board determined that upon the conclusion of Mr. Kyra's term, the size of the board shall decrease to 7 trustees. It's worth a quick look at the proposed board composition. There's also some data about board independence. Seems like good housekeeping. Moving on to elect the trustees, it needs to be approved by the holders of a majority of the common shares. The board is encouraging shareholders to vote for the 7 nominees. Here is some background on each of the nominees. It's a mix of experience, which is good. For example, John Schissel has 30 years of experience in real estate. Mary Twynham is the former executive vice president and chief financial officer of Buffalo Wild Wings, so brings a lot of business experience to the board. The company discusses that they do not have a formal policy regarding diversity. The Nominating and Governance Committee recognizes the value of having a board that encompasses a broad range of skills, expertise, contacts, industry knowledge, and diversity of opinion. Let's move on to another item, executive compensation. This is always an interesting one. Shareholders get to give their opinion on whether they think the executives are being paid fairly. It's an advisory vote, so it's not binding, but the company does take it into consideration. The proxy statement dives into how the company performed in 2024. Let's take a peek at the numbers. Net loss was $1.27 per diluted share compared to net income of $2.22 per diluted share last year. That doesn't look great at first glance, but the company wants us to consider other factors. Centerspace highlights that core FFO increased 2.1% to $4.88 per diluted share compared to $4.78 last year. The company also mentions that same-store net operating income grew 3.7%, driven by revenue growth of 3.3%. Looking into the details of the compensation plans, they had a mix of metrics including core FFO per share, same-store NI growth, adjusted EBITDA margin, and strategic goals. The company has a long-term incentive program in which officers can receive restricted share unit awards that vest over 3 years. These awards are earned based on our total shareholder return. The company has entered into double trigger change in control severance agreements with their officers. To receive this, a change in control would have to occur and the officer's employment would have to be terminated without cause. The benefit includes a lump sum and health benefits. The board has adopted a written related party transactions policy, which sets forth policies and procedures for the review, approval, or ratification of any related party transaction required to be reported in filings with the SEC. Since the beginning of 2024, there have been no transactions and there currently are no proposed transactions in excess of $120,000 between the company and a related person. The officers are required to retain an amount equal to 60% of the net shares received as a result of any equity awards we grant to the executive officer. This is a safeguard to make sure the ownership is maintained. The report says that some of the transactions were not reported timely due to administrative delays. A director sold some shares on December 10, 2024, and it wasn't reported until February. That looks like a human error type of situation. Let's get to the third voting item, the approval of the Centerspace 2025 incentive plan. This is a new plan that, if approved, will replace their current one in June. The board believes this new plan will help them attract and retain talent, provide incentives, and align interests with shareholders. Under this plan, the maximum aggregate number of common shares that may be issued is 650,000. The company mentions that the board reviewed a study from their compensation consultant. Finally, let's look at the last proposal, ratifying Grant Thornton L as the independent auditor. For the year ending in December, basically shareholders get to say whether they agree with the company's choice of auditor. If shareholders don't ratify this selection, the audit committee will review their options. The document includes what Grant Thornton has charged the company for audit and other services. Audit fees were $587,600 and audit tax fees. The company's most important financial performance measures used in 2024 to link NEO compensation to performance were ETUA total shareholder return, DECOR FFO per diluted share, S-in-store NOI growth, ested EBITDA margin. So what's my take on all of this? Centerspace seems to be in a bit of a transition period. Net losses raise a few eyebrows, but they're pushing hard on adjusted metrics like core FFO to show growth. The board seems engaged in ensuring alignment with shareholders through these incentives, so that's good. However, it's important to keep an eye on debt levels and any potential impact on those long-term growth plans. Are the risks outlined by company well understood? I think a reasonable target price range would be based on a deeper dive into their assets and cash flow to make more accurate predictions. Overall, Centerspace is navigating a challenging market, but is attempting to take steps to create a better business going forward. Whether the shareholders buy into this vision will be revealed in May. Thanks for watching, and I hope I could help you better understand this proxy statement. If you found this helpful, please subscribe, like, and comment down below. I will see you next time.